The point is, in modern money theory, you can print up as much as you want. We all know that's the true definition of inflation. So how do you get away with that? Well, with programmable currency, as I just said.
Welcome back to the Retirement Fiduciary Podcast, a place where we have authentic, no BS discussions about retirement planning, investment strategies, and wealth management. Whether you're approaching retirement or if you've already made work optional, this show is for you. Now, here's your host, Adam Koós, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group at libertaswealth.com.
All right, welcome back to the Retirement Fiduciary Podcast, where we simplify financial topics and help you make smart, confident decisions about your money. In today's episode, I'm joined by David Morgan, publisher of the Morgan Report and one of the world's leading voices on precious metals and monetary systems. He's known as the Silver Guru. David is a calm voice, warning of economic storms, and today we're talking about what you need to know before the next financial shock, the truth about central bank digital currencies, and how independent money systems may play a role in protecting wealth. This is an eye-opening conversation, very entertaining, very interesting, very different from most of the things that we do. So let's go ahead and dive in. All right, David, thanks so much for joining us.
It's good to be with you, Adam. Thank you.
Yeah, so we started talking offline, and I think this happens a lot when doing podcasts. I think we talk too much offline. We should have recorded a bunch of that because we were having some good conversations before we hit record. But before we get started on the topic that you requested we talk about, which I love because we both have a shared passion for that topic, so I'm going to leave people in suspense here. But for those who may not know a whole lot about your background, what first drew you to studying precious metals and the monetary system? That's not something that, most people wake up in the morning and go, you know what? I think I'm going to start really, nerding out on precious metals and monetary finance.
Well, as corny as it sounds, I was 11 years old when the coinage changed. And I used to get 25 cents a week allowance living in the country, and there were silver quarters. And I had that for, a year and a half, 2 years in that range. And then one day my dad gave me a new quarter. It was what I call Johnson Slug. It was the Cupro nickel. And as a kid, I just intrinsically knew, wait a minute, the silver one's got to be worth more than this copper one. But none of the adults in my area shouldn't be paying any attention to it. So I'd say that was sort of the the little shot that I didn't pay a lot of attention to, but it was a bit of a, maybe even subconscious. I don't want to overthink this, Adam, but so that was the start. And then I started thinking, well, how do these big buildings get built? I mean, I know my dad has to save to pay a mortgage, and I guess he borrowed money. I'm 11 years old. But as I progressed, 12, 13, 14, got into school, got into junior high, I really started to question what was going on. And so I did a study on my own. And I found out how the banking system worked, and I learned about fractional reserve banking. I said, well, that doesn't seem fair. It doesn't seem right. It doesn't seem like that's the way it works. And then when I found out the Federal Reserve was a private corporation, I really went off. So I started getting involved with different books, authors, and at that time, newsletter writers that were in snail mail that talked on the topic. So it just took off from there.
What about the question that we were talking about? We were kind of going off on a few tangents here, and I just love this that you wanted to talk about it because I literally didn't even have it on my list today. But you said you wanted to talk about fiduciaries, the fiduciary law, fiduciary advisors, who the true fiduciaries are. And I'm not going to lead you here because I don't really know. We cut it off and we said, okay, let's just talk about it. So why don't you start?
Yeah, I've got 5 points. I'll try to be brief. But first of all, fiduciary duty and sound money. Okay, there's a tie between being fiduciary responsibility and protecting purchasing power. It's not about just growing your assets. It's about making sure that those assets can buy and isn't eroded away by inflation or currency debasement. The second one is why precious metals belong in every retirement plan. And that is because both gold and silver act as insurance against systemic risk. It's not a speculative asset. It's actually a foundational thing, but most people are taught to believe otherwise. Drawing the parallels, just as fiduciaries diversify across stocks and bonds, they must diversify across the system. And not many CFPs do. I know, I work for them and I talk to them fairly often. And the historical proof, if you look at the inflation from the 70s and 2000s, retirees who held precious metals preserved their wealth. I just put up a chart on my X showing the last 25 years of the 4 majors, not using bonds. We use gold, silver, the S&P, and the DJI. Gold led them all for the last 25 years. The S&P was above the Dow or vice versa. They were very similar, and silver was just some of them. So, and I'm also, let me stop here and just say, look, I advocate a hedge position. I'm not a gold bug, put everything you own into the metals. I don't think that way. What I do think is balance. But to balance across the systemic risk in the overall system, you need to be prepared, which in most cases is about 10%, which means you got 90% to do in stocks, bonds, real estate, private equity, or whatever you care to. But you need to have a balance, and most people don't. Last couple points is longevity, outliving your money, low bond yields and stock market volatility. The most negatively correlated asset to the stock market is gold. Not gold stocks, gold. And again, you don't need to load the boat. You just need to have the appropriate amount for your retirement planning or your portfolio if you're younger. And last one, takeaway. I already said the amount I think consider if you're really looking far out and you think maybe inflation's going to get worse or the economy's actually contracting or whatever, some of the stuff I write about, maybe a 20% hedge, but certainly that'd be like the max. Consider both physical bullion and carefully selected ETFs or mining shares. And there's a special class of shares that we specialize in that have outperformed the metals significantly. And we want to emphasize liquidity, jurisdictional authority, and custody, both in physical and in the mining sector.
Okay. So kind of along those same lines, because obviously there's a lot of reasons to own precious metals as a hedge. You mentioned as a constant in your portfolio. Some people will call it a fear trade at times, depending on what's going on in the market, right? But you've said in the past that freedom is the first casualty of a rigged monetary system. And that quote kind of stood out to me. What do you mean by that?
Well, a real true free society is on a voluntary basis. You're not under an authoritarian rule, authoritarians that say you can say this word and you can't say that, or you must this or that. So really the number one thing that kind of got me into money on a bigger perspective was that money transcends everything, Adam, as you know. Doesn't matter, what nation state you're in, what your religion is, what your background is, what your culture's like. Everyone needs money to survive. And if you have the power of money, you care not what the jurisdictional outlay is. In other words, it's in communism, socialism, free market capitalism, you name whatever ideology. It doesn't matter. If the bankers are still controlling the currency, they're controlling that ideology or who runs that ideology. So that's really the big picture. On top of that, if I can't go in and purchase what I want, in other words, my choices are limited because of what we see in China, which is really the beta test for the world with the new system, and it's based on a social credit score. So I might be a billionaire, but if they can program my money, which is done by the CBDC, then it doesn't matter how much money I have. Money used to be freedom. In other words, we used to talk about financial freedom. And that number varies for everybody. But as a 20-year-old, if I had like $2 million, I would have been financially free as all heck. Now it'd be 20 million, or whatever it is. But that doesn't matter now because you could have that amount of currency or assets or balanced portfolio, including precious metals. Precious metals aren't going to exempt you from it, although, we could go off on a tangent and say, well, maybe you could do a private transaction, blah, blah. But the idea is, look, if they control the money and the new money is going to be more controllable, you have less freedom.
Okay. And I don't know that we're changing gears necessarily here, but talk about freedom and talk about, you talked about products. When I say products, I mean investment products, different types that are out there. When you talked about precious metals and gold, I don't think people are talking a whole lot about this yet, but I think they're going to, and that is the topic of central bank digital currencies. Why do you think that they're a pivotal issue, and what might they mean in the future for both individual investors and financial advisors as time rolls along?
I think all I have to do is really know where to go and look at what's in black and white. In other words, it's not some theory, it's what they've said. So I gave a speech at the 50th anniversary of the gold show in New Orleans last year. I think it was around November. And in that speech, I said the new monetary system. And every bullet point that I made came straight off the website of the BIS, Bank for International Settlements. And anyone who knows how the monetary system works knows that the BIS is the banker's bank. So basically, I just, I hate to use the word dumbed it down, but I made it more bullet point-ish and point by point went through the whole thing. And then I think the better backup to solidify what I just said, Adam, is this. Mark Carney, when he was at the Bank of England, gave a speech at the UN, United Nations, the Davos or World Economic Forum, and in Jackson or Jackson Hole, Wyoming, at the Fed. And the speech was basically the same the whole way through. And it said, here's what we want for the new monetary system. We want an unbacked digital currency that has no backing, as I said. It's pervasive worldwide, and there will be a wipeout of, let's say, it'll become a cashless system. And it will be modern money theory, meaning they could inflate to wherever. Now, we all know, most of us know what inflation really means. It debases the currency. So a dollar today is going to be worth less 10 years from now than it is now. That's pretty well known by the public without any economic training whatsoever. The point is, in modern money theory, you say you can print up as much as you want. We all know that's the true definition of inflation. So how do you get away with that? Well, with programmable currency, as I just said. So in their system of a CBDC, and it doesn't necessarily have to be a central bank. It could be JP Morgan or Amazon or maybe X. Maybe Twitter comes up with a new currency. Or maybe there's multiple ones and they all blend into a clearinghouse, which already exists. If you go to ISO 222, you can read that. I'm not going to divert too far, but I do my homework here, Adam. And they all clear through the same place. So basically, I don't think they really care if it's a digital X or a digital Y or a digital Z. As long as it clears through their system, they're happy. So the point being, again, what I've already emphasized is that you may have a lot of money, but you may not be able to disperse it the way you want with your free will. It's guided by your carbon credit score, what your diet's like, where the rent controls are, if you can drive in that city or you have to walk, and all these type of things, which we see daily if you're paying attention.
Yeah, I think it's really interesting when you talk about inflation. I don't want to go on a huge tangent here because I will, but the definition of inflation, I feel like, has changed a little bit over the past couple of years, especially with COVID. And I'm not going to go there, but I digress. You've said, another thing you've said is the Great Reset isn't coming; it's already underway. Now, when you say the Great Reset, what do you mean by that? And what signs are you seeing that it's already underway?
Well, the bankers, whether they're extremely smart or not, I think needs to put in the proper context. Whether they're smart, they're very clever and they don't want to lose their power. So the reset that we have is what I've already outlined. And it's been put into China. It's in all the large cities. We're talking 400 million, which is more than the population of the United States. And that's only the cities population of China, maybe 500 million. Don't get my number incorrect. I'm not sure the exact number. But out of the 1.2 or 4 billion in Chinese, 1 out of every 5 people on the planet is Chinese. They have a system that's working perfectly well. It's a cashless system. You, in many transactions, do not interface with anyone personal. In other words, like what we call 7-Eleven in North America, those type of situations in China, you walk in, no one there. You get entered into the convenience store by facial recognition. Door pops open. You walk in. You get your potato chips. You get a Band-Aid and you get a Coke, and you put it on the bench, and it gets scanned, and your WeChat or Tencent is automatically debited. But let's say you ran out of power on your phone. Guess what? Not in all cases, but in some cases, you give them a handprint without a chip. Your thumbprint and your palm are unique to you and you alone. And they have these in China. So, oh, darn, my phone, you can still pay for it. It's registered and you walk out. And no one really blinks. I mean, this is something that's been integrated in their society and they just accept it and away it goes. There aren't a lot of dissidents in China that think the way I do. And I'm not saying my thinking is correct. I am a freedom fighter. I think I should be able to choose how much I want to spend on whatever. In fact, I'll go as far as say sometimes it's nobody's business but mine. But regardless of my thinking, I am not for a situation that restricts our freedom.
I think that's interesting because last summer, so summer of 2024, my wife and I and our 2 boys we traveled to South Korea with their Taekwondo team, with their Taekwondo sparring team. And we went from Seoul all the way down to the island, Jeju. And there was one place in the middle of nowhere. It was at it was at Taekwondo headquarters. in South Korea, where it was not quite handprints or facial recognition yet, but nobody was working there. And it was kind of like an honor system thing, which I thought was fascinating in itself. But I can see what you're saying, where that could translate into more of a facial recognition, handprint, phone. That's really interesting. So we talk in our office a lot about, the brain trash that people consume, whether it be inadvertently or not, through financial media. From your perspective, how does the mainstream financial narrative obscure the real risks going on in the financial system?
Well, having worked in that field for a brief time and, being an apprentice, you might say, to a CFP that was one of the best in our area and listening to the pitch a few times, basically sit down. And of course, you want to be cordial and you're working with other people's money and you talk about, well, here's inflation. And inflation we're going to assume is 4%. And our track record is that we've compounded at 7% over the last several years. And so we're going to have a buffer of 3%. But all that's just pulled out of the air, really. Because first of all, future results cannot be based on past performance, which they say in the disclosure, you have to sign it. But the point is, they really don't talk about why your money keeps depreciating. You just put out the idea of there it is, but no explanation. If you had me there and I said, all paper money's failed throughout all of history. It's the one guarantee you can make in the financial system, yet to be proven this time. But if I could give you something 100% in the financial system, you'd probably be all ears. You'd want to know, well, what's that investment that's guaranteed? Well, you mean you give me that return on this and you could guarantee it? Wow, I'm all in. Of course, annuities do that and all that. I don't want to digress too far. But there we go. So we have a situation where a lot of financial planners are telling the truth, but as I would say, not the whole truth and nothing but the truth, because that really involves taking a look at what's happened in monetary history and what little bit of action you need to take to make sure it doesn't happen to you, your portfolio, your family, or your business. And those things are really pretty easy to accomplish, but yet it's kind of left out of the financial planner's handbook. And that's where, I specialize in what I do. So, I mean, if you're going to connect with me, you're going to get, here's where your 10% goes. And, for your listeners, I'm going to give them, themorganreport.com/fiduciary, and they'll be able to get a 50-minute call with me, not one of my staff, not one of my understudies, not a recording. I'm going to talk to them. And that's, I charge $1,000 an hour for consultation. So that's a $250 gift for your listeners. And if all they want to do is buy precious metal and know where to buy it, at probably the best place as far as premiums are concerned, very close to wholesale. I can't give wholesale. I'm not a wholesaler. But that alone would probably be worth their 15 minutes.
Now, I'm going to ask this similar question for two different audiences here. So let's start with financial advisors. So for professionals out there, we've talked about CFPs, financial advisors, financial planners. How should they be thinking about incorporating metals into portfolios for their clients without sounding like a conspiracy theorist or alarmist?
Well, I think the best thing to do is education. And I would, at the risk of sounding like I'm lazy, and I'm not, I'm quite a hard worker. You might just outline the key points or maybe have a consultation with me and then maybe use an AI. So make this very succinct and understandable for the average investor in a friendly manner, that we are not metals heads. We simply want to protect what they have and let it write out, 5 bullet points. I think that might be one approach for certified financial planners. In those cases, again, I could connect you with a hedge fund manager and a fiduciary that is a good friend of mine over 20 years. He is, licensed and all the stuff. And he also has a storage facility, which is private outside the banking system. So just to have that in the back pocket, let's say that CFP is looking for a new client. The guy's got, 25 million to invest and he's shopping planners. And this guy has that one edge and, hey, you know what? I think 5% in metals might be worth it. And I've got a connection that could probably not only store it for you privately and get you probably the best prices that anyone I know. And if he has that little 2 minutes I just spoke over 1.5 minutes might sway him to get that client. So, there are advantages to, let's say, what I would call authenticity in the monetary system. My mission statement is to teach and empower people to understand the benefits of an honest financial system. That goes from top to bottom. That goes from your janitor to your top CEO. Because if we're all on a level playing field, we're telling the truth to each other. But if the people at the top get to print something for nothing, and we got to give our labor for it, it's an unjust system.
What about individuals? So I said I was going to ask about two audiences. So, what's the simplest, call it easiest, most practical way to get started if they want metals exposure, if that's something that they desire?
There's a meme out there called silver stackers, and it's basically for, the average people out there. And I'm not better than anybody. Believe me, one of the first things my dad taught me is remember, you're as good as anybody. And then he paused. But remember, you're not better than anyone either. And that always stuck with me. No, you just save. You save in metal. I mean, I taught this. I've been teaching this for years, that if you've got a savings account, save in silver and or gold or both. And if you do that over the long term, you're going to preserve your purchasing power. If you look at the CAGR, which your audience would know, the compounded annual growth rate, for the last 25 years for gold is over 10%. Real estate's only 7. The Dow's about 7. The S&P's around 8. So gold is outperforming everything. I'm going to digress for a moment, but a very high level CFP in Europe called me and we had a little chit chat, and he worked with, 10 million or up to get managed by him. And he did a great job, but he said, you know what, David, if I just put them in gold, we would have done just as well.
No, okay, fair enough. What about, when we were offline, we were talking about, the financial system, storm clouds, call it, I always like to use analogies. I always use weather analogies when talking about the markets. So, you've called yourself a calm voice, warning of economic storms. What would you say are the biggest economic storms that you see forming right now?
Well, I'm trained as an engineer. I mean, my passion's always been finance. I've been in for, many, many years. I've been investing since I was 16 years old, even though you have to be 18. My dad got me in under the Uniform Gift of Minors Act, so I could trade the DJI as a kid. But I think trained as an engineer, you think in extremes. So you go from 0 to infinity. So let's go for the worst case. There's a complete and total financial collapse. Oh my God, the banks are closed, okay? Let's go to the worst case so that we can think backwards, because that's probably never going to happen. In that case, what really happens? And that is that all the wealth stays there. All the wheat, all the oil fields, all the churches, all the movies, all the restaurants, it's all there. None of that goes away. What happens is there's a financial problem. And really, in those cases, you usually get a repricing. So stocks that are overpriced get revalued. Maybe businesses that are overpriced get revalued. The shopping malls that are, 2/3 empty, they get revalued. Maybe they get repurposed to apartment buildings or, some kind of new hydroponic facility or whatever. And that's what the collapse really does. It really is kind of Mother Nature's way of flushing the system and kind of getting, again, that overused word reset. So that's the worst case. Is that going to happen? No, I highly doubt it. But within that context, we're seeing that slowly happen. Look at how we get our, groceries sometimes, or our, day-to-day whatever. I mean, it's all, not all, but a lot of it's delivery. I mean, I didn't know what Amazon was a few, decades ago. And now, I'll be honest, a lot of stuff, I don't have the time. It's easier. I got a Prime account, click the button. I got new stationery. I've got new pens. I've got whatever I need for the office, whatever. And so these shifts, you see the trend, and the trend continues. And that's the trend. We're going to see less and less brick and mortar, more and more work for home. That's why the commercial real estate market is such dire straits. And that's going to hit hard next year in 2026. It's probably going to be worse than the real estate financial crisis in 2008, which is residential based, because most of commercial is local areas that put up these huge loans for commercial properties. And now these people are working from home. So, and I'm not trying to be a doomer. I'm not. I am a realist. And these things have happened before. In fact, if I could digress for just a moment, if you go to themorganreport.com and go to the About tab and scroll down just a little ways, there's a movie called The Four Horsemen. I'm in it. It's not about me. It's about the message. It's over 12 years old, but the message is very clear, and I would say very objective. And they have some really notables. I mean, people from like the IMF that speak in that, Noam Chomsky, for example, and some others that are in that film that kind of put this is it is, this is where we're going, and here's what we can do about it. There's no need to hit the panic button. And if I did, talking about an all-out financial crisis, I Well, apologize because that wasn't my intent. My intent is, and even in the worst case, really, it's a deep breath and we carry on. That's my point.
And why I'm curious, because I've been talking about commercial real estate um, in a similar way since COVID.
Yeah.
My opinion is that when you look at these bigger companies, the publicly traded companies, or just large middle to upper market, privately held companies as well, when they sign a lease, they don't sign a 5-year lease. They sign a 10-year, 15-year lease. So there's companies, I should say, who signed leases in 2016, 17, 18, well before COVID, that have leases that aren't going to expire until 2030 something. So it's been my opinion that I think we're probably going to see more and more companies send people back home for work once their leases expire, and that a lot of the people who've been brought back to the office have they've done so just simply because they have the space and they don't want to let it sit empty. But I'm curious, you said, if I heard you right, that you're thinking next year. Why do you say next year?
Because, I look at the tail end of the curve. I think there's some out there even longer than you're suggesting. And also it depends on what the banking system at large does. Some of those loans are callable, some are not. Many of these loans, people don't know what a callable loan is. That's what happened in Depression. Some of these people had money in the bank to pay their farm off in total, but the bank went under, so their funds disappeared and they couldn't make the payment that they already had saved. That's pathetic. That's a system that doesn't work. So I'm not suggesting that. I just kind of went off on a tangent there, but you get the idea. And also, it's kind of a copycat system where, if this bank gets nervous and starts saying, look, let's liquidate this, or let's sell our loan. It's only worth, let's say, a number, 60 cents on the dollar. Let's discount it to 50 cents to our friends at this bank over there because we need the cash and we need it now. And then all of a sudden that gets out on the street and the next bank says, why are those guys discounting their commercial property loan, man? They need the cash. What's wrong? Well, maybe we better start, So these things can get out of hand at times. Of course, there's all kinds of circuit breakers in the system now, as you well know, and they have worked in the past and they probably would work in the future. But you get my point. I think that was what I would tell you.
Okay, that's fair. Yeah. And then speaking of, major financial shocks, if I heard you say earlier 10% when you talked about precious metals specifically, so I'm not going to hold you to that because I'm sure I shouldn't say I'm sure, but I assume your recommendation maybe has changed over time, your personal recommendation. But if a major financial shock were to hit at the end of 2025, beginning of 26, let's just say, what do you believe financial advisors, financial planners, and investors, for that matter, should have in place today?
Yeah, that's an excellent question, and I'm glad you gave it. Thank you. And this is what I love to do, is having that engineering mindset. So there was a study done by my friend Nick Barisheff of BMG Group in Toronto, Canada. And he paid Ibbotson and Associates to do a portfolio analysis under all conditions. And under all conditions, their recommendation is 15%. So, and that was gold, silver, and platinum. That's how they did the study. Now, Jeff Christian, who's the general manager for CPM Group, you can look up CPM Group. It used to be on Wall Street. They moved a couple streets back. Jeff and I have known each other for at least 20 years. And he's very well regarded, especially on the establishment side. He writes the silver study, the gold yearbook, platinum. He does all the metals. And we have a pretty good dialogue. I get his study every year and look at it intently. So he did an analysis from 1968 till I think about 2 years ago. And it was 25% holding based on that time frame. So, when I say 20%, which was my max, I always said, when I wrote the investing rules book, I was asked to write the specialty on silver. Give us 10 rules of silver investing. You can look it up, 10 rules of silver investing by David Morgan. Investing rules books came out years ago. It isn't published anymore. And my 10th rule was too much of a good thing is too much of a good thing. 10% is adequate for almost all people under all conditions to be hedged in the precious metal. However, I was speaking in one of the investment conferences as a keynote, and at the end of the speech, I upped it to up to 20% based on, and we were just starting into the wars in the Middle East with Operation this, that, and the other thing. And I said, under these conditions, I think you could go higher. It's up to you. So I've kind of waffled between 10 and 20, but 10's usually adequate. And I can do that for my lifetime. And when you look, when I was just a kid and the silver market went from 5 to 50, that's a 10 bagger. And gold went from 300 to 900, which is, 300%. And that means everything else goes to zero. Your real estate might get cut in half, which would kill most people, but it's not
Yeah.
going to zero. And your stocks aren't
Yeah.
going all to zero. All this. So you got to kind of balance out what we're trying to achieve. And what I'm trying to achieve is peace of mind in a very unstable, ever-changing, and quickly accelerating world. Let's give you that. Oh, you know what? I think the guy makes sense. He's a little off, but you know what? I feel better now that I got some precious metal. That's what my intent is. And I think most people feel that sincerely.
Yeah, I don't. I think that owning non-correlating assets is good. I do think, contrary to popular belief, that there's something to be said for. I hesitate to use the word timing, but as I mentioned offline, we talked about how me personally, I believe very strongly in relative strength and all the studies that have proven that it works over time. I like to call it, using an analogy, I always like to call it investing in the playoff teams and avoiding the rest. We don't have to own every asset on the planet all the time, because that means we're going to own the best and we're going to own some really, really terrible investments, which I don't see the point of that. So I feel like, whether it's investors or advisors, I think that looking at the markets going forward, it's just a matter of time. I mean, I started my career 10 days before the World Trade Center went down. And, I've been through some pretty nasty times in the market, but I'm always reminded, it's usually when I'm by myself, I'm doing analysis, whether it be weekly analysis, monthly analysis for our model portfolios, but I'm always reminded by the fact that two things. One, it's been more than 16 years since the end of the last major sustainable market crash. I mean, yes, technically COVID was a crash, and technically 2022 was a crash by definition, but it wasn't the mortgage crisis, and it wasn't the dot-com bubble. And those things come along every so often. And the second thing is that the US has been outperforming anywhere in the world for a long, long time, pretty much since 2007, 2008. So I think that a couple things. One, I think that there's probably, I'll say three things. One, there's probably going to be a time, and we're probably past the halfway point where we're closer to a big crash happening at some point in the next, I'll say, decade, just to be safe, because I always say I'm not a trend predictor, I'm a trend follower. Second of all, I think that when that time comes, there'll be plenty of time to reallocate assets out of riskier assets into real assets, things like precious metals, for instance. And then third, I think that people need to be careful not to allow every markets in turmoil CNBC special to freak them out to the point where they're afraid to spend their money. They're afraid to have fun, because let's face it. I mean, you mentioned, I think this might have been offline. You mentioned you're not sure if the next big crash is going to happen in our lifetime. You also mentioned that when the crash happens, things aren't going to zero. I mean, residential, commercial real estate, it's not going to zero. And I'm also a big advocate of the fact that even though I'm a trend follower, even though I'm a market technician, when markets crash, it is still temporary. Like, it's gonna come back, right? However, and this is the key, if you're 20s, 30s, and you're in your 40s, maybe you're okay just buying, holding, and praying, and trying to avoid the freak out moment. But if you're retired or close to retirement, but worse than anything, close to retirement and or retired and taking a distribution from your account, the math is really, really ugly when you're taking money out of a portfolio that's crashing to the tune of 35, 40, 45%. And now I went on a tangent. So before we wrap up, I want to know, is there anything that you're working on right now that people watching or listening to this should know about? And what's the best place for people to connect with you and follow your work?
Well, the best place to follow me is themorganreport.com. And depending on your proclivity, there are icons at the top right. So if you're an ex-follower, there's a direct link there. LinkedIn, a direct link there. Facebook, YouTube, they're all there, just one click away. And then as far as what I'm working on a documentary called Silver Sunrise. And it's at the URL silversunrise.tv. And it gets a little bit on the spiritual side, so you can put me in the woo-woo category there. It talks about, if you Google or look it up, what does money do to most people? You find the stress, fear, and control that money has over their lives. I mean, sometimes people are divorced because of financial problems. Sometimes, the job or whatever. So it does cause a lot of stress, and it doesn't have to be that way. So this looks at really balance in your life, and that comes from all aspects, but certainly in a world where you have to earn a living for most people, that comes down to the money power and the money question. So we look at that from several aspects. We look at it primarily from an energy aspect, because really energy is far more important than money, because the world runs on energy, not on money, although we're taught differently. And so it's a big picture, kind of walking out of that presentation, whether you watch it at home or a big screen or whatever, with asking questions. And I'll defer back to what I said earlier, and that's the film, The Four Horsemen, that's at my website. Just go to the About column, or About tab rather, scroll down and watch The Four Horsemen for free. And the documentary will be for free as well. I funded most of it myself. I will take donations to kind of help the cause, but I'm not relying on them. Should be out within about a month. And I would be very much happy if you wanted to view that and maybe do another interview with me and say, hey, you really hit it here, but you missed this part here, David. You should have talked about that. So I may do a sequel, I may not, and I'm open to criticism. Look, none of us are perfect. We're just human, and we're trying to help each other in this human experience, and let's put money in its proper perspective. It's important, but in my long years, it's not the most important. Our relationships to each other are.
I always like to say money is a unit of choice. The more units you have, the more choices you have, right? But yeah, no, I'll definitely check out The Four Horsemen. Believe it or not, I like to nerd out on stuff like that, and I always have my boys watch it with me. I always think it's really educational for them to see stuff. There's some books out there, some audio books, some documentaries that we'll watch together. It's always typically when mom's not around, she doesn't really care for it. But anyway, all right, if you'd like to connect with David, check out themorganreport.com, and we've included all his contact information, links, resources, everything's in the show notes. And as I always say, there are thousands and thousands of podcasts out there, and there are thousands of as I always say, there are thousands of podcasts out there, and you chose to spend time with us today. So thank you so much for tuning in, and we'll see you next time.
We hope you enjoyed today's episode. If you like a second opinion on your retirement plan or investment strategy, please head over to libertaswealth.com. This podcast is for informational purposes only and should not be considered as legal, financial, tax, or as a basis for investment decisions. Always consult a certified financial planner or a fee-only fiduciary advisor before acting on any ideas discussed.